Property taxes. These are taxes based on the value of the property you own. Oops. And by property, I mean land and permanent structures. Okay, so if you own land and it has a mobile home on it, the mobile home does not qualify into the value of your property. A mobile home is considered personal property and you have to pay different kind of taxes on that. Actually, you register them kind of like a car and you pay an annual registration fee. But it's not considered to be what's called real property, and real property is land and permanent structures. So a house with a foundation built into the ground. If you put a shed, if you put just like one of those Rubbermaid kit sheds, that doesn't add to the value of your property because it's not a permanent structure. But then if you build a shed with this concrete foundation, that's sort of like a garage more than that adds. So they have to be permanent structures. And then you pay taxes based on the value of that land and the structures on it. And people come out and appraise the properties, the tax appraisal people, to determine how much it's worth. Now, tax appraisals are generally lower than retail value. So if you bought a $100,000 house, let's say, your tax value is probably not going to be that high. You're going to be paying taxes on probably less than that. Sales tax, you guys are all familiar with sales tax. Okay, so sales tax is taxes collected based on the value of the items you purchase, and sales tax has 3 levels: state, local, well, state, county, and city. So that's why the sales tax in, let's say, Lake Mary is different than the sales tax down in Kissimmee, possibly. Because there's the state sales tax, and the county has a sales tax, and then the city has a sales tax, and they get added together. And the state one obviously is the same statewide, but then the counties can change it, and then the cities can change it, so that can fluctuate by a couple cents. Income tax is tax that you pay on the amount of money you earned. Okay, and I'm going to put in here taxable income. Because there is a difference between general income and taxable income. Taxable income is the amount of money that can be taxed. Okay, this is determined by deductions. And these can be either pre or post-tax deductions. Pre-tax deductions are things like a retirement fund that you're putting money directly out of your paycheck into. The money comes out of your paycheck, goes into the retirement account, and then they calculate the tax on the money that's left over. And then the post-tax deductions are things that you get to put on that Schedule A form that we were talking about just a second ago. The itemized deductions also lower your taxable income. And there's certain categories of those that are allowed. And so what's left after the deductions is the income that can be taxed. And then the Internal Revenue Service, the IRS, There's their website. If you ever have any questions, there's tons and tons and tons of publications and forms and fact sheets and everything you could possibly never want to know about taxes on that website. This is the government agency that collects the taxes. Well, and they also monitor. If they determine that there's something, you know, hinky about your tax return, you can be audited, and that's where they come and they look at your proof of everything to determine that your taxes were done correctly or not. Oh my goodness. The filing status, that's what I was just talking about, those different columns. Whether you're single or married or filing together or married filing apart or head of household. It's based on your living situation. Okay, and it determines your tax rate. Okay, single, this is unmarried people. Okay. Married filing jointly or a qualifying widower. Okay, so married people filing together. Which is combining your income. Okay, and then the other thing is a widower or widow. That was widowed within the last year. Okay, because what's happening at that point is, let's say you're getting up there in years, and we're going to say you're going to live long time, so you're like 95, and then your spouse passes. And for some reason you guys were still working at 95, because you had lots of energy or something. They had income, and it needs to be reported on the tax forms. So you can still file married filing jointly instead of as single and pay the lower tax rate because you were together during that year. Okay, married filing separately. This is married people that file 2 separate returns. And, you know, the income is split between the 2. There are many reasons why people might choose to do this. The largest one that I can think of that comes to mind would be you're still legally married, but you're separated. So you're not living together anymore. But, you know, there are other reasons. Maybe one spouse makes considerably more money than the other spouse, and so if that other spouse files separately, they get a bigger tax return than if they file together. You know, I mean, there's different reasons why you might choose to do this. And then head of household is a special filing status. Okay, you have to be unmarried, and you have to support other people. Okay, and now there's a difference between like a legal dependent and a not a legal dependent. Like if your girlfriend or boyfriend lives with you and they're not working and you're paying for them, they may be your dependent, but you cannot claim them on your taxes. You don't have any actual relationship to them. The dependents must be related to you. have to have legal guardianship. So let's say I have foster kids. I have legal guardianship of them. I could claim them. Or if my parents are elderly and they live at my house and I take care of them, I can claim them. Or my brother or my sister that's for some reason unable to work and they live with me and I take care of them. Or my own kids. But not my deadbeat roommate that doesn't pay any bills. Okay. Also, people have gotten in trouble for this for the past. Dependents are not pets. You can't claim your horses or your dog or your cat or their medical expenses as they're not dependents. They have to be human. They can't even be really close to human. You can't like claim a chimpanzee either. Okay. All right. So if we're looking at the tax table, so this is like a column from the tax table. You have the at least but less than. So Ron makes $51,482. So we look between $51,450 and $51,500. That's that range. And then once we've got that range, we're in this row. I'm going to highlight underneath it, not so I don't cross it out. And this column, because he's single. So we find where those two meet, and that's the tax that you owe. So Ron would owe $9,213 in taxes. Now, what you owe has this number here on the tax table has nothing to do with what you've already paid. That's just your total tax bill. Now, your employer has been taking money out of your check, and they may have taken more out than you owe. They may have taken less out than you owe. This is just what your tax bill is, and then you have to go from there. After you figure out how much you owe, then you determine how much you've already paid, how much you need to still pay, or how much you're getting back, you know, all these things. But I'm going to pick up where we left off. Okay, so our tax table only goes up to $100,000. So you can calculate this tax using a schedule. If you look at the tax table packet, the schedules are on the back, the very back of the packet, and they look like these. And you have Schedule X if you're single, Schedule Y1 if you're married filing jointly, Schedule Y2 if you're married filing separately, and Schedule Z for head of household. Okay. So we're using the Schedule Y1 because we have Maria and Don, and they're married and they're filing jointly, and together their combined income is $153,900. So that's above the limits of the tax table. So we're going to use the schedule. If you look, you have different income brackets between 0 and 16,000, 16,000 to 65. 65 to 131, and then 131 to 200. Their 153 falls into this area here, between 131 and 200,000. So after we know where they fall, your tax is this of the amount over this column. So if we look at this, we've got $25,580 plus 28% of the amount over this. Okay, so the so that's how you would read that whole sentence, that whole line. 25,580 plus 20%, 28%, sorry, I read that wrong, of the amount over 131,450. Now they made 153,900, so first we have to figure out how much is that over the 131,450? Bless you. All right, so we take and we do our subtraction. Three minus 1 is 2. Okay, so 153,900 minus 131,450 is going to give us $22,450. This is the amount over. So we're going to do 25580 plus 0.28 for our 28%. 28% of 22450. Darn it. That's a 6. So their tax bill is actually going to be $31,866. This tax schedule that we just used, these are for informational purposes. As you can see, they go through all of the pay ranges. But they actually create the worksheet for people over 100,000. So if you look on the next to the last page of the tax table, you'll see these worksheets that look like this. And with these, it allows you to actually fill in the amounts, and it tells you then add this, multiply that, subtract that, whatever. So what you do is, if we're still using Maria and Dawn, their 153,900 was their income. Okay. This is between 100,000 and 131,000, 131,000 and 200,000. So they're right here. So you put in their income right there. And then it says multiply by 0.28. So I'm going to take their income and multiply by 0.28. And that goes here. That's a 9. And then subtract this amount. So minus 11,256. And that's your tax bill. Now if we compare the two, 31,866, 31,836. They don't always match. That's because this is an exact calculation and this is an estimated calculation. Sometimes this one works out in your favor, sometimes this one works out in the IRS's favor, because it's a zone as opposed to an exact calculation. Okay, so your gross pay, that's the total amount of pay you've earned before there's any deductions. So your salary or your hourly times the number of hours you worked, that's your gross pay. Your net pay is what you actually get to take home. That's after deductions have been made. So gross pay is larger than net pay. Net pay occurs after taxes have been taken out, if you have to pay for medical insurance out of your check, if you have a retirement account that comes out of your check, if you have disability insurance, life insurance, a flexible spending account for medical expenses, things like that. Those all come out, and then you get net pay. You get a pay stub. Your employer is legally required to supply you with a pay stub. It does not have to actually be a physical paper pay stub, though. It can be electronic. It has a list of your wages and then a list of all of your deductions. And they have to be on there. So if they're taking money out of your check, the reason they took it out has to be listed on the pay stub. When you first get your job, you fill out the W-4 form. The amount of taxes that are taken out of your check are based on the information that you report on your W-4 form. The lower the numbers of exemptions that you claim, the more taxes they take out. However, the less likely you are to owe money at the end of the year. People will recommend that if you're single, claim 0, because when you file your taxes, you're only allowed to claim 1 because you're single. So if you claim 0 on your W-4, then they take out more tax money so that at the end of the year, you're not going to owe any. Whereas if you claim 1, you'll be right on. Either they took out the exact right amount, they took out a little tiny bit too much, or they didn't take out quite enough. There's those 3 options. So the taxes that can be withheld from your check are federal, state, or local taxes. Now in Florida, we don't have state and local taxes, like state income tax or local income tax. We just have the federal income tax. But if you live in a state like Georgia, Georgia has a state income tax. California has state income tax. I think Connecticut does, but I'm not 100% certain on all the states that have state income tax. And then local would be like a county or a city income tax. But we don't have those either here. So all you'll ever have to deal with is federal, as long as you stay in Florida. If you leave, I have no telling. That'll depend on where you go. At the end of the year, so taxes get reported between January to December. So January 1st to December 31st is a tax year. So what happens is after December 31st, your employers have to calculate and provide you with your tax information so that you can file your taxes by April 15th, tax day. And they have to give you a W-2, which is a wages and tax statement. And they are required to have that postmarked by the 31st of January. It doesn't have to be in your hands by that day, but it has to be like sent out in the mail or given to you by that day. If they're just handing them out, they have to hand it to you by that day. If they're mailing them, it has to be postmarked by that day, January 31st. And it totals everything that's been withheld from your check that has anything to do with your taxes. So if you have like a tax exempt retirement account that comes out of your check, that'll be listed on there. Flexible spending accounts get listed on there. Taxes that have been taken out of your check get it listed on there. But things like your medical insurance, which don't affect your taxes, don't get listed on there. And then there's also something called a Form 1099. A 1099 is given to you if you are not an employee of a company, but you do contract work for a company. They don't take taxes out, and because you're not an employee, they don't pay workman's comp or hazard insurance or anything like that on you. You're not an employee, you're just a contractor. Well, they don't take taxes out, so you get a 1099, and the 1099 is just, this is how much money you made this year contracting for me. You can also get a 1099 from your bank if you earned interest on a savings account or CDs or money markets or anything like that. If you have stock dividends, you'll get a 1099. If you made commissions, like sales commissions, and they didn't take taxes out, they'll give you 1099 for that. The big thing is that no taxes have been withheld from that. So if you're doing contract work and you're not an employee, you want to make sure that you put aside money to pay those taxes later, because you're considered self-employed at that point. You have to pay a higher tax rate of self-employment tax. So let's work some of these out. Barbara started a new job and she wants to make sure that they're calculating her pay correctly, which you do want to do, because mistakes do get made. Somebody might enter a decimal wrong on like your hourly, like they, instead of saying you work 25.2 hours or something, they might put in 2.52 hours. Like, you know, just, I mean, things happen, accidents happen, not on purpose, but you know, life happens. So you do want to check your paycheck. Her gross pay was $269.75. She has FICA tax, that's your federal income tax, is your FICA. Medicare tax, federal withholding tax, state withholding tax, retirement insurance, disability insurance, and medical insurance and dental insurance. Those all come out of her check. Okay, so the first thing we want to do is identify the key We have two percentages, 6.2. I'm sorry, I lied. FICA is not your federal tax. That's your Social Security. You have 6.2% and 1.45%. And that's of your gross pay. Oops, wrong pen. So we're going to take that $269.75 and we're going to calculate the Social Security by multiplying it by 0.062. And then we're going to take it, the same number, and calculate Medicare by multiplying it by 0.0145. So with those type of deductions, it's based off your gross pay. It's not like they calculate your Social Security, take that out, and then use that new amount to calculate the next thing. It's all based off the gross pay. Okay. So we'll do 269.75 times 0.062. 1673, sorry, 72. And then 269.75 times 0.0145. And that's going to be 391. All right, once we've got that, we can then calculate her next net pay. By subtracting all of her deductions. So we've got her Social Security, her Medicare, we've got federal withholding, that came directly out of the problem. You've got state withholding, so that's state income tax, retirement, oh, come on. Disability, okay. So we're in disability insurance, and then we're subtracting medical insurance and dental insurance. Okay. And when you subtract all of that stuff, you get 153.40, 155.43. So her gross salary was $269, but she brings home $155. Lorna's biweekly pay pay stub. And assuming that her salary and deductions are the same throughout the whole year, we want to know how much is taken out for federal and state taxes for the whole year. Okay. Now this is 1 month. No, I'm sorry, this is 2 weeks. So we have to figure out how many of these are there in a year. Okay. So you have bi-weekly, or you have semi-monthly. Okay. Semi-monthly is when you get paid 2 times a month. And bi-weekly is when you get paid every 2 weeks. And you might think, well, that's the same thing, except it's not. Twice a year, you have a 5-week month. Okay, so when you're paid semi-monthly 2 times per month, this is going to be 24, sorry, not 24, 12 months times 2 times a month, so you get 24 checks. If you get paid bi-weekly, so that's every 2 weeks, there are 52 weeks in a year. Divided by 2, you get 26 checks. So those 2 months a year where you get 5 weeks in the month, because of the way things don't work out quite perfectly evenly, you're going to get 2 extra checks if you're paid bi-weekly than if you're paid semi-monthly. Typically semi-monthly you get paid on like the 1st and the 15th, or the 15th and the last day of the month, something like that. And then bi-weekly is every other Friday or every other Thursday, however they set it. Okay. We don't really know, based off of this date period, if she's getting paid every 2 weeks or semi-monthly, but up here it tells us bi-weekly. So that's the every 2 weeks. That means she's going to have the 26 checks. Okay. So we've got every 2 weeks, so she's getting 26 checks. And if every check is the same, she's having this much taken out for federal and state taxes. So we've got 1,147 for federal and 280.89 for state. We'll add those together. This is going to happen 26 times a year that she gets this much taken out, so we multiply that by 26. So she's paying, I left out a 3, sorry. She's paying $33,341.36 per year in federal and state taxes. You'll have on here your social security number up top. This is your social security number. And then this number here and here, this is your employer ID number. That's kind of like the social security number for business. It will have your employer information, and then your information. This box in it, so that's why I'm labeling everything. This is your wages. Your wages, salary, tips. Okay. This box is your federal income tax withheld. This is your Social Security, wages, and I'll explain the difference between the two in a minute. And then this box over here is the Social Security and Medicare withheld. Okay. These other boxes, you have allocated tips, you have different areas where they can put in any retirement information or flexible spending account information. We'll get more into that in a little bit. Down at the bottom is like the local zone, the local and state tax zone. So this is your wages. This is state income tax. And then you get your wages again. And then you have local income tax. Now, when you look at this, these boxes here, right now they have the same wages in them, $76,350, but they can change. These two don't have to necessarily be the same. We talked a little bit yesterday about taxable income versus income. If you have deductions that reduce your taxable income, like you paid into a retirement plan or you paid into a flexible spending account, those get deducted from your income before you pay taxes. So this box 1 could be less than this box 2. And the reason, or no, sorry, that's 3. The reason being is because you pay Social Security and Medicare on your total income no matter what. There's no deductions for Social Security and Medicare, but you do have deductions for federal taxes. So your federal income wages can be lower than your Social Security wages because of those deductions. And whatever those deductions are would be listed in these blank spaces here. Does it make sense? So how much did she pay in taxes? Well, it doesn't say federal taxes, it just says taxes. So we're going to count her federal taxes, her state taxes, and her local taxes. So she's got federal, state, and local. Joanna apparently pays a lot of taxes. So she pays $22,287.50 in taxes. And if you were to wonder how much of a percentage of her income that was, you can divide that by her income, $76,350. She's paying 29% of her income in taxes. And her employer uses an electronic W-2. You'll notice it's electronic because of this little e-file. Okay. We've got wages listed in box 1 and Social Security and Medicare wages. So here's the Social Security, here's the Medicare wages. And you can see that there's a difference. Okay, so, yeah.
Our worksheet's missing that entire document.
Yep. if her wages are $78,900, and then directly under that, it says her social security wages are $92,100. And this is what I was kind of just talking about. If I take her social security wages and I subtract her regular wages from that, I have a difference of $13,200. Well, if you look here and here, we have two amounts that were not shown on the other W-2. Okay. This says CAF 125. This is what's called a cafeteria plan. And this is sort of like prepaid medical. It's sort of like a flex plan, flex spending account. They take money out of your account before your taxes come out, and then you can use that money to pay medical expenses, which then are no longer tax deductible because you didn't get taxed on the money that you're paying with. And then E will represent a code. This will be some code that is listed in your tax books. Most likely it's a retirement plan. And if we take those two things and we add them together, we get the exact difference between the federal wages and the Social Security wages. Okay. And so the reason that these are different is because of pre-tax deductions. Okay, pre-tax deductions reduce your federal taxable wages, but not your Social Security. Or your Medicare. Okay, so tax deferred contributions. There are certain types of accounts, retirement accounts or saving for your child's college funds, that can come out of your check pre-taxes. And what happens is you're not taxed on that money at all until you take the money out of the account to spend it. So IRA, it's an independent retirement account. There's like a Roth IRA. There's a 401k. There's the 529, which is an account for saving for money for your kids to go to college, tax deferred. But when you take the money out of the account, then you pay taxes at whatever the tax rate is at that time. So, you have to make those choices. A cafeteria plan, most commonly known as a flexible spending account. Those are the ones you hear about all the time. But a cafeteria plan allows you to take money out of your account or your paycheck before taxes are taken out. So it reduces your taxable income. And the money is set aside to be spent on certain things. It can be spent for medical, it can be spent for child care. If you have elderly parents, it can be spent on their care. And then non-reimbursed medical insurance. The flexible spending account is the most common of those. It's an employee-sponsored account. The money comes out of your check and goes into an account. And you can either get like a flex card Visa thing that allows you to go to the doctor and you just charge your doctor's visits or your prescriptions on it, or you have to submit forms to get reimbursed. You pay for the thing, like child care, you pay for the child care and then you fill out a form and then they send it back, send you a check. The thing with the flexible spending accounts, which is also true of most cafeteria plans, is you have a certain length of time that you have to use the money in. Usually it's within a year. And I don't mean within a year of when you put the money in the account, I mean a calendar year. Usually the deadline is the end of December. If you don't, some of them do allow to like February, they give you kind of a buffer. But if you do not spend the money at the end of the specified amount of time by the deadline date, it goes away. So if you have $200 sitting in a flex account and you don't use it, it's gone. You've lost $200. So that's kind of the penalty for having those. You have to make sure that you spend it all. That's why you'll always see those ads at the end of the year, like you spend your flex benefits here for like the eye, get new glasses, or the dentist, go to the doctor. Lots of people make appointments at the end of the year trying to spend that last amount of money so that they're not losing it. This is a 1099. It looks a little different than a W-2. It still has some of the same information. You will have your social. You still have an employer ID number. However, they're not actually your employer. This is for independent contract work, royalties, commissions, bank interest, some construction, like if you hire a contractor for construction, things like that. Taxes have not been paid on this money. You have the amount of money that you earn. There is a spot for federal taxes withheld. This is not ever filled in. Because if somebody's giving you a 1099, they didn't hold back taxes for you. And then there's some other things on here, but I would say 98 out of 100 of these will only have this box filled in right there. Okay. Your social. Employer ID. But it's not, they're not actually your employer. You're an independent contractor. When you receive one of these for contract work, you're considered self-employed. That's if you're doing it from like a type of an employer. You're doing contract work, but you also get them for bank interest and like commissions or royalties. So if I'm Stephen King and I'm getting my big giant fat royalty check for my new super scary book that I wrote, I'm gonna get a 1099, and it's gonna have a lot more than 5,000 right here because I'm Stephen King. You know, so. There's 3 forms. They're all 1040. You have the 1040, 1040A, 1040 Easy. The short forms are the 1040A and the 1040 Easy. The 1040 Easy is like the extra short form, 1 page. The 1040A has a double-sided single page, and then you're allowed to fill in 1 other form to go with it. So at the most, 2 pieces of paper. And then the 1040 is the long form. And I honestly don't know what the maximum number of pages that can be is, but usually it's at least 4. Yeah. But depending on your personal situation, let's see, so if you've got your 1040 form, and your Schedule A because you're itemizing deductions, and your Schedule B because you have bank and stock dividends and bank interest, and then you have a KED, that's your 4 forms. But then if you're self-employed, there's another form. If you're a farm worker, there's another form. If you're a household worker, they're employer, employee like a butler or a maid, there's another form. If you employ a butler or maid, there's a form. If you have foreign investments, there's a form. If you have, you own your own business, there's a form. I mean, there's like forms for every possible scenario. So it can get really long depending on your situation. Your dependents are your kids. People you have legal guardianship over. So if you have like foster children, or if you legally care for your nephews, uncles, siblings, rights removed kid, you have legal paperwork. Immediate family members you care for. They have to be related to you though. You can't claim your fifth cousin's best friend. You can't claim your best friend. You can't claim your boyfriend or your girlfriend, or even you can't claim your fiance that'd be married to you to be claimed. Okay. Exemptions lower your taxable income by a specific dollar amount. Last year that amount was $3,800. It may change this year. I'm not 100% certain on that. But for filing 2013 taxes, that amount was $3,800. You claim one exemption for yourself, and then one for every dependent that you have. So if you and your spouse, there's 2 exemptions. If you and your spouse and 3 kids, that's 5 exemptions. And each one is worth $3,800 deducted from your income. Okay, 1040EZ is the shortest form, but it's also the most specific as to who is and is not allowed to use it. In order to use the 1040EZ, you have to be single or married filing jointly. You can't be head of household, you can't be married filing separately. You cannot have any dependents. So it's just you or just you and your spouse. Your income has to be less than $100,000. It's only certain types of income that are allowed, and there's a list. Most people don't fall into those other categories of non-allowable income, but there's a list. And then you cannot have any deductions to itemize. You can only have one source of bank interest, so you can claim bank interest on a 1040EZ, but it has to be off in the same bank. Because if you have more than one bank, you have to fill out a different form, and you can't fill out that form with this form. Okay, and no stock dividends from different sources either. So those are the requirements to use the 1040EZ. Basically, for the first several years you pay taxes, you can generally use it, and then after that things start to get complicated as you get married and have kids and stuff. Okay. So we are going to fill out a 1040EZ for this person. Okay, and I'm going to actually fill out the actual forms. We're going to switch to the document camera view. Okay, she has her W-2, and she got a 1099 for bank interest, one bank. So she made less than $100,000. She's single. She only has one source of bank interest, so she can use the 1040EZ. So out of your paperwork, go ahead and pull out a 1040EZ, and I'm going to get this set up to allow us to use it. So okay, we have Elizabeth Allison's information, okay? Her name will go up here. Okay, her name is Elizabeth Allison, and her social security number goes there. This is her address. You don't have to fill that out. Okay. Over here, that's weird. It's not showing. Over here, you'll see that there's something about if you want to donate $3 to the presidential election campaign. That's personal choice. You don't have to. They don't come after you more or less for donating or not donating. So, you know, if you want to, you just click on that. Okay, wages and salary and tips. These come from box 1. That's this box right here. Okay, so $83,600 goes right there. Okay, taxable interest has to be less than 1,500 on this particular year. We're using 2012. It may or may not be different for 2014, but it'll always say she has from her 1099 taxable interest of $956. Okay. Unemployment compensation and Alaska permanent fund dividends. She would have received paperwork for this, which she did not, so that's 0. Or you can just leave it blank. We add these lines together, 1 through 3, and this is the adjusted gross income. Okay, so, and you can see that this is like the easy form because it walks you through it step by step. Add lines 1 through 3. Okay, if someone can claim you, click here. That's if you're still young enough that your parents are claiming you on your taxes. If they're not claiming you on their taxes, you don't check anything there. Okay. If you're single, you enter 9,750. If you're married, filing jointly, you enter 19,500. What this is right here is the standard deduction. You know, we've talked about you can itemize deductions. Well, if you're not itemizing deductions, you get the standard deduction. And so everybody filing singly gets the exact same amount. Everybody married filing jointly gets the exact same amount deducted unless they're itemizing. So she's single. So I'm going to put the 9,750. These two numbers get subtracted. And that gives us her taxable income. Okay. So far, okay? Now, we find the federal income tax withheld from the form. So we go back to her W-2. It's right here in this box 4. No, sorry, box 2. 15,884. Okay.
Isn't it 5? Wait, okay.
Yeah, that was the Social Security withheld. Yeah, so it's box 2. So 15,884. Earned income credit. We're not going to do this right now. Non-taxable combat pay. We don't have any of that, so we're going to just bring this down. Okay. Tax. We use this number right here, the adjusted taxable income, to find her tax. And we find that in the tax table. So this is tax table. So we're going to find 74,806. So on page 87 is 74,000 box at the bottom right there. 74,800 to 850. She's single, so this is her tax rate here, 14,736. Okay, so she owes 14,736, but she paid 15,884. If you pay more than you owe, you get a refund. If you owe more than you pay, you have to pay more. Okay, so she's getting a refund. We're going to subtract those two numbers. She gets a refund. And then the rest of this, if you want it direct deposited, the bank information goes there. She has to sign it. If somebody else did her taxes for her, that third party designee, that's like if you go to H&R Block or something and they do your taxes for you, they'd have to sign there. Oh no, sorry, that's paid preparers use. Third party designee. Do you want to allow another person to discuss this return? So, I don't know, maybe you want your parents to be able to discuss your tax return or something. You fill that out. Any questions on this form, the 1040 easy? You guys think it's relatively easy? It's meant to be. Okay, so for tonight, we're gonna just do, we're not gonna do any of the tax forms yet. Do 3 through 23 odd. Remember yesterday I assigned 1 and 2. So go ahead and just do 3 through 23 odd.